So, hello everyone, and welcome to our deep dive with Angelo, Gallo, and David Monoszon. Today's topic is rates, yield curve, financials, and all the topics that go together. Hello, Angelo, how are you today?
Hey David, how are you?
Good. Could you just start and give us a quick tour? What is the significance of these different depth durations?
Okay. Put up a chart of the 2-year yield, David.
Yes, that is up.
It's up.
Yeah.
Um,
Oh, sorry. I I need to share the screen. I will. Uh, it's up, but I have to share it with you. Sorry. Uh, can you see it
there we
now?
go. It's coming up. Yes.
Okay.
Okay. All right. So hopefully everyone clicked on the watch stream box on their screen. And what everyone should see here is is the 2-year U.S. Treasury note yield. And the reason I think David wanted to just start off on this is because when central banks, including the US Federal Reserve, start to raise interest rates, the markets start to raise rates way ahead of them. So you'll notice that, David, if you can scroll um, back on that chart, go back a little bit more, your mouse, go move from right to left. I
So
want everyone to see, yep, right about there. What's that date?
here it's February
Put,
7th.
yep, move over to the left a little more. Go left.
Uh huh.
Keep going left. Keep going left. Right about there. Okay. So just go to the right a little bit more to November, December. Yep, right in there. Perfect. Perfect. Okay, so everyone will notice where Dave has his mouse, and you'll see that the 2-year yield on the US Treasury note started rising back in that period of time. Now, why is that? The reason that happens is because the financial markets begin to anticipate and front run expected central bank rate increases, specifically the US Federal Reserve. You'll see a similar pattern if you look at the 2-year German notes, the 2-year gilts, two-year oats. You don't have to flip, David. You can just stay where you are. Um, so markets front run expected behavior from central banks. Now, what this chart is telling you, with an interest rate of 1.94, that chart is basically saying to us that it expects, if you take 1.94 and divide it by 0.25, it's saying that it expects roughly 7 rate increases of 25 basis points apiece by the US Federal Reserve. That's a lot. And we don't think the Fed will ever actually be able to implement that. And that's probably a discussion for another day as to why. But this is what we call the front end of the curve, 2-year notes. And then, David, you
So
can
just to
maybe
make
from
my
here.
thoughts clear, so the front end of the curve, so that is not very distant, 2 years only, that is reflecting the idea of markets where the rate hikes or rate cuts, where are they going, right? Within next,
Oh,
1 year.
that's correct.
Okay,
Yes,
thank
that,
you.
that, that is correct because the front end of the curve is highly, highly sensitive to central bank changes in interest rates. So that's where you see it the most. That's where you see, the biggest impact. You will see a less of an impact, and I'll give you some correlations in a moment. But David, if you move from the 2-year yield to the 30-year,
Okay. So these are bonds that
Okay,
are which their payment is due in 30 years, right?
that's right.
Okay.
So now we've gone from a 2-year bond yield to a 30-year bond yield. Okay, so the 30-year bond, as David just said, is long duration. So this is now we're looking at what we call the long end of the curve. So the 2-year is the short end of the curve. The 30-year is the long end of the curve. And you will notice that today's rate is basically 2.45%. It's not that much higher than the 1.94 on the 2-year yield we were just looking at.
But the time
Okay?
difference is huge because I mean, who knows what happens in 30 years? So the risk is much higher, and the difference between those yields do not really. It should be, the difference should be much higher. The 30-year bonds should be much more expensive, right? To reflect the risk of so many years that nobody knows what's going to happen, right?
That's right. You would think that the 30-year would be at least double the 2-year, right? So, 1.94, let's round it up to 2. So if you double that to 4, right, you might say, oh, well, the 30-year yield, shouldn't that be somewhere up around 4% or 5%? And as you can see, it's not. And there's reasons for that too that we'll go into at another time. Now, what I want to say about 30-year yields, if anyone has a pen and paper handy, you can write down these statistics that I'm about to give you. So the studies show that interest rate increases post World War II. So these statistics go back to the end of World War II. And what the statistics say is that whenever the Federal Reserve raises interest rates, the 30-year yield only moves about 0.34%. That's not much. 0.34. So if the Federal Reserve raises rates 1%, the effect on the 30-year yield is only 0.34%, which is kind of interesting. On the 10-year yield, if the Fed historically raises rates 1%, the interest rate there moves only 0.26%. Actually, it's the other way around. I'm sorry. The 10-year is 0.34% movement, and the 10-year and the 30-year is 0.26. So you might think that if the Fed raised rates 1%, that the rate change on the 30-year bond and the 10-year bond would move 1% as well, but it doesn't work that way. And the reason it doesn't work that way is because when the Federal Reserve starts to raise interest rates, markets begin to anticipate what the effect of those rate increases will be on the economy. Okay? And that's a conversation that we will have for another day. But that's why the US 30-year yield is only at 2.45 today.
Yeah.
Not nearly as high as anyone might think. Okay, so those are the correlations dating back to the end of World War II. Whenever the US Fed raised rates 1%, the effect, like I said, was 0.34% on the 10-year and 0.26, meaning the effect was only to push up the 30-year yield basically a quarter of a percent. Not much at all. Okay, that's because since the Fed has a much greater control on the front end of the curve, meaning the 2-year, it doesn't have nearly as much control over the 30-year yield because that's where the markets really control that
Yeah.
through discounting future economic activity.
So in other words, the further you are in the yield curve, the more distant duration, the more it is impacted purely by market, and Fed does not have yet any control over it, right?
That is correct.
Okay, so that means
Unless,
that
oh,
when the bonds are the more distant duration they are, when they are trying to price in the future economic development. For example, now we are expecting economical slowdown. So what do, let's say, 30-year bonds do, or 10-year bonds do in economical slowdown?
Interest rates come down. So the price, and let's just back up a moment because a lot of people get a little lost with how bonds actually work. So when bond prices go up, interest rates come down. It's an inverse relationship when you're dealing with bonds. If interest rates, if bond prices are coming down, interest rates are going up. And the reason for that is bonds are issued in denominations of $1,000, right? So let's just make believe for a moment that $1,000 bond comes out with a 5% coupon, a 5% interest rate. If the market expects inflation and the market expects economic growth, it's going to push down the price of that bond, which then changes what we call the yield to maturity. Because let's say the value of that bond goes from $1,000 to $900. That change in price has to make that 5% coupon equal to what the new market interest rates are if the economy is getting stronger. So that means that that $1,000 bond drops down to, let's say, $900. Then what that'll do is it'll change the yield to maturity from 5% to maybe 6%. Okay? That price of that bond will adjust according to current market expectations for interest rates. On the flip side, if the value of that bond goes to, let's say, from $1,000 to $1,100, and now somebody wants to buy that bond from me, they're not really going to earn that 5% coupon. They might earn 4% interest because interest rates have come down. So the value of that bond is going to adjust either upward or downward depending upon market expectations for the economy. And if the price of the bond goes up, interest rates will come down. If the value of the bond goes down, interest rates go up. That's how bonds work all the way across the curve,
Okay,
from
if I
treasury
understand it
bills
in
to
other words, treasury bonds, uh, uh, they have a fixed coupon, but the way to adjust and to make the earned interest rate different, to make it higher or lower, it it basically happens by the price change of the bond. So if the bond is more
that
expensive, that means you are earning less yield, and vice versa. So
that's
there is this opposite function, right? That everybody has to
that's right.
understand.
That's right. Now the bond will always pay the equivalent of 5%. Okay. It doesn't matter what interest rates do. The interest payment is the interest payment. But the way that the interest rate gets adjusted is through the price of the bond. And that's what we call yield to maturity. Meaning, if David, you buy a bond at par for $1,000 and the interest rate is 5%, and it's a 30-year bond. And then 5 years down the road, interest rates rise and the value of that bond drops to $900, right? And you decide you want to sell that bond and I buy that bond from you, okay? I'm still going to get, as the buyer, I'm still going to get the 5%. However, when that bond matures, I'm going to get $1,000. Now, I paid 900 for it. That extra $100 represents the extra interest, quote unquote, interest I'm going to get when the bond matures because I'm not going to get $1,000. I'm going to get $1,000, but I paid 900 for it. You see? So the principal change, the price change of the bond, affects what we call yield to maturity. So there might be 25 years left on that bond. Angelo's going to continue to collect the 5% interest. But when the bond matures, I'm going to get an extra $100 because I paid 900 for the bond. But when they mature, I'm getting the $1,000 that you would have gotten had you just held it. You follow?
Yep. Okay, so let's discuss.
And also, David, vice versa. Vice versa. So let's just say interest rates go down and the value of your bond goes from $1,000 to $1,100. Okay. I'm now going to collect that 5% interest, but when the bond matures, I'm going to get $1,000, even though I paid 1,100 for it. Okay, so the fact that I'm losing $100 essentially reduces the 5% interest rate that I was receiving all along. And so again, that term is called YTM, yield to maturity. And you can go to Investopedia or Google it to do a little bit more of a deep dive to understand the concept.
Yeah, and I encourage our listeners uh, to look it up on Investopedia. And now let's talk about stuff that you will not find on Investopedia. And it's basically, what is yield curve telling us? Also, are there any other indications that can tell us the health of credit markets?
Okay, so David, first off, let's put up a chart of the 210 curve.
210 curve, okay. Here it is.
And also, David, on the right-hand side, in the right-hand panel, go all the way down to the bottom and bring up, no, all the way to the right, way to the right. No, no, move your mouse all the way to the right-hand panel where the
Yeah.
tickers are.
Oh, yeah.
That's it. No, go down, go down, 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 and bring up. No, 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 no. Go all the way down,
Which one
down.
do you
Keep
want?
going.
Which one do you want?
No, I don't want the ticker. I want you to bring up the panel that's hidden in the bottom right.
Ah, okay. This one.
There you go. Okay, perfect. Okay, so this is what we call the 210 yield curve. It is simply the 10-year yield minus the 2-year yield. And the reason this is important to follow is because it gives you an indication of what is happening to interest rates, and more sophisticated investors use the yield curve to identify whether or not economic risk is improving or whether or not economic risk is deteriorating. Now, in a normal, healthy economic environment, you normally have a yield curve that is rising. Now, that's not what you see here. If you look at the line chart all the way off on the left, you'll see that the um, yield curve has been compressing. And historically, if the yield curve gets to zero, now right now it's at 0.237, but just a month and a half ago, 2 months ago, that spread was 1.28. 1.28. So the yield curve has compressed almost a full 1% or a full 100 basis points. What that is saying is that the bond markets are expecting um, trouble of some sort. It doesn't know what, but it's expecting trouble economically of some sort. And historically, once interest rates or the yield curve spread goes to zero, so let's say it goes from 0.24 to 0.15 to zero, and then a negative number, historically, when the yield curve inverts, that's when it goes negative, it means it's inverted. And it means that the 2-year yield, right, the 2-year yield is higher than the 10-year yield. So right now what's happening, folks, is that the 10-year and the 2-year are doing this, okay? And if it inverts, meaning the 10-year actually goes below the 2-year, historically, like I think it's almost 100% of the time, you get a recession. So the reason we follow the 210 curve is to gauge economic risk. So even though interest rates are rising, because the Federal Reserve is trying to push rates up in order to, hedge off some inflationary pressures, the bond market is saying, no, something is going to happen. Something's going to break along the way. And if this keeps doing what it's doing, meaning flattening of the curve, that hints at economic problems and economic slowdown. So that's why we look at the 210 curve. The other one, David, is the 530 curve. This is just another one that I like to look at. So David, maybe you can go to the 530. Okay, this is simply the 30-year yield minus the 5-year yield. And you can see the same thing is happening. It's compressing. It's flattening. So both of those curves are saying the same thing. They're flashing yellow lights. They're saying, be careful, be careful. Things aren't all what they seem in stockland.
So basically,
Okay,
Angelo,
so
what I see in this chart now, I'm in this one. This is a monthly chart, so each bar is 1 month. So what I can see that
mhm.
last year, 2021, we had a big economical boom. Everything was growing. All the stocks, Tesla was going up. All that. So during that boom times, the yield curve was just going up, 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 right?
That's correct, and that's exactly what you want to see.
And it peaked
Now,
in summer. It peaked basically in the summer, and since then it's going down.
that's right. That's exactly right. And the large cap stocks were still doing okay, and large cap stocks basically peaked out in November. But what the yield curve understands better than the stock market is actually, let me just back up for a moment. The bond market is a much better forecaster than the stock market. If anyone really wants to understand what's going on underneath the surface, you have to follow the credit markets, the bond markets, because they are much better at forecasting economic growth and economic turndowns or economic declines than the stock market. Eventually, the stock markets catch up, but it's always the bond markets that provide clues as to whether or not there's a storm starting to brew. Kind of like, you look outside, it's a nice sunny day, but then, you start to see some dark clouds come in. It's not raining yet, it's not windy, there's no hail or sleet, but you can see the dark clouds beginning to form. That's what the yield curves kind of do. They kind of act like a canary in the coal mine. I don't know if anyone has ever heard that phrase. I've used it, many, many years. Miners used to take canaries down into coal mines with them because there is something called, I believe it's methane gas, and you can't smell it. And if you inhale too much of it, it can kill you. So in the old days, they used to bring canaries down into the coal mine, and if the canary died, they knew that they needed to get out of there. So it's an early warning sign.
So here
Now you might
basically,
say,
if we looked at the 30 minus 5 year curve, we would see in June, at the end of the June, we would clearly see that things are no longer the same, right? Something is changing. And I remember all these small stocks, all these specs, and all this stuff that peaked in June. That by November it was already killed. That everything was minus 50%. So all these May stocks and all this shit that peaked in summer. And here was a clue.
yep, that's right. And now let me offer up another piece to the puzzle. Here's what David just described is absolutely correct, and here's what was happening during that time period. Beneath the surface of the stock market, small cap stocks were deteriorating. They were steadily deteriorating. And by the time we got to November, they were starting to do even more damage. And it spilled over into large cap stocks. And the credit markets were slowly sniffing that out. And that's what they tend to do. Now, another indicator of developing risk, David. David, let's go to the high yield spreads.
Okay. So this is the American one.
Yes, that's the American one. So what this is it's a chart that's basically saying, and it's measuring the amount of interest now over U.S. Treasuries that junk bond issuers have to pay. So that when you monitor that spread, it gives you also an indication of whether or not risk is rising or whether or not risk is declining. So what's happening right now, David, is you can see on the chart on the left. David, go to the lowest point on the chart on the left, to the daily chart. That was December, and even if you go out to the
And
left a
end
little
of
bit farther,
December,
what's that?
right? 28.
Okay, go farther left. Go left to that V bottom. Go farther left. Right? Yeah. Okay. So the high yield, the spread right there was roughly 2.8%. And starting in December, folks, do you see how the spread started to rise? And now from 2.8 to 4.21. So what that's saying is that junk bond markets are starting to price in some stress. Now, our economic models are basically suggesting that we have some serious economic deterioration coming, and the yield curves that we just looked at, and now the rising spread of high yield debt are confirming the fact that there's problems beneath the surface that the average investor of stocks isn't seeing. Okay. And a similar phenomenon is happening in Europe. In fact, in Europe, it's a little bit worse. So, David, let's take a look at the European high yield spreads. Okay, so you can see that the European high yield spreads are at 4.74. It's even higher than here in the US. Okay, and people might say, well, this is Russia, it's this, it's that. The fact of the matter is that the EU economy as a whole was going to start slowing probably in the second or third quarter of this year anyway. And everything that we're seeing from, the war in the Ukraine is simply pulling forward much more rapidly the slowdown that was expected to come anyway. And that's an important point because a lot of investors, we like to call them macro tourists. Oh, there's going to be peace in Ukraine. Stocks are going to go up. Oh, the Federal Reserve is going to be slow with raising interest rates. Oh, stocks are going to go up. No, the economic slowdown is a mathematical certainty. There's no way it can't happen simply because the rate of growth we had last year was so steep and so high that it's mathematically impossible to comp the comps, if you will. We can't we can't beat the rate of change of economic growth from last year, and neither can Europe. So that means that the rate of change is going to begin to slow down, and the markets are going to adjust to that reality. And so we're already seeing warning signs in the credit markets. We're seeing warning signs in high yield spreads. And now we actually have some anecdotal evidence about two bond failures in the last 2 days. The first one, a couple of days ago, is a high yield lender called Affirm. They they're basically like a payday lender. They will lend you money based off of your paycheck, and they are also called uh, buy now, pay later. So they will lend you the money to buy something, and then you can pay it off over time from your paycheck. David, the ticker is AFFRM. Yes,
Here it is. Yeah.
there it is, right there. Okay, look at that stock chart. The stock market does not like high risk lenders right now. So 2 days ago, a firm wanted to issue some bonds in order to be able to buy more assets. It's called asset-backed securities. You guys can also look that up, asset-backed securities. And their bond offering failed. There was no investors willing to buy the bonds. Yesterday, the same thing happened with Tesla. Tesla wanted to issue some bonds so that they could do leases and whatnot for the sale of new cars. Well, guess what? There were no takers. The Tesla bond offering failed. So we are starting to see the early warning signs of economic distress. And it's interesting that we have a firm and now Tesla. And Tesla, everybody knows Tesla, right? You would think that, oh my gosh, Tesla's a big company. Everybody knows Tesla. How could they have a bond offering, an asset-backed bond offering that fails? Well, they did. And here we are. Now, a lot of this does also tie into the Federal Reserve. And again, that's going to be a discussion for another day. But let me just say that when the Federal Reserve starts to raise interest rates, what they are trying to do is dampen demand on the part of consumers by raising interest rates and making loans more expensive in order to mitigate the effects of inflation. The problem this time is that the ECB, the US Fed, they've done quantitative easing, QE. And now they have trillions of dollars of bonds on their balance sheet. And they're at the point now where they want to start to unwind all of the bonds they bought the last 15 years. That's called quantitative tightening. Well, the effect of that, in my opinion, is going to be to reduce liquidity within all financial markets. And that expected reduction in liquidity, we're now starting to see it. We just went over it in the bond markets, the credit spreads, the yield curve. And that will probably eventually start to spill over into the stock market as risk taking becomes more dangerous, because a lot of hedge funds and whatnot out there, they use leverage. And if liquidity gets reduced, there will be less leverage in the system. And the only option is to take down risk by reducing leverage. And
Okay,
the
Angelo,
net
we have
effect of that,
15 minutes left. Maybe why don't we move to the reasons why we are right now, buying TLT? Why are we shorting XLF? Why we are shorting financials? And why do we short HYG, the high yield debt?
okay, let's start with high yield debt. The charts we just went over, credit spreads, yield curve compressing, okay? If there's stress in the high yield markets, you don't want to own the high yield markets. You want to short it in an economic decline. It's that simple. Okay. You don't want to be long high yield bonds. You want to be short high yield bonds going into an economic decline. Credit spreads are confirming that. Okay, so that's that piece. Uh, Financials, bank stocks. Well, when the yield curve compresses, that's generally bad for bank earnings. Why? Because banks use the money that you put on deposit to lend out at a higher interest rate. Well, if interest rates are doing this, if they're coming down, the net interest margin, meaning the difference between what banks pay you on your deposits and what they charge on a loan, if that spread, the NIM, net interest margin, if that compresses, then banks earn less interest. Going into an economic slowdown, we've got a flattening of the curve. You don't want to be long banks going into an economic slowdown. So you want to short them. That's the idea behind that one. And what was the other question you had, David? There was a third one.
So we are buying. Why are we buying TLT?
Oh,
Even though the
okay.
directional signal is red on our model algo.
Yes. Yes. Okay. The reason why we're buying TLT, which is essentially the 30-year Treasury bond, it's really 20 years plus, but let's just make it simple and call it the 30-year Treasury bond. The reason we're buying it is because as we get closer and closer to the second quarter, meaning April 1st, and the rate of change of economic growth begins to speed up to the downside, what David and I are basically thinking is we want to position ourselves for what we see coming. Even though the signal is still bearish on 30-year bonds, we want to front run everybody else. So we're trying to get ahead of everybody else. So we've been slowly adding treasury bonds to our portfolio in expectation that interest rates will actually start to come down because of the decline in GDP. Same thing for Europe. Same thing with European bonds. So that's the idea there.
Okay, Angelo. Well, thank you very much for all this info. Nasdaq is going to our target level, and it's time to execute. So I suggest that we go to execute.
Okay. All right, everyone. Take
So
care. See you all
it
later.
is definitely recorded, and I will put it. I will post it and give you all link. Thank you very much, Angelo, for your time.
Okay. See you later.
Ciao.
Bye.